Good afternoon, everyone. Hope you're doing well. Hope you're enjoying the weekend. There's been some big moves in the markets the last couple of weeks, lots of things happening. So I thought I would do a general market update. Let's have a look at where some of the major asset classes are at, starting with the world bond market as measured by Vanguard's Total World Bond ETF. So this is a 5-year weekly chart we're looking at. And keep in mind, those are the highs from 2020 when central banks were printing trillions of dollars to overpay for bonds to suppress interest rates at super low levels. And the world bond market saw about a 20% decline in price. You can see the low in October and the low in October 2023, so 2022 and 2023. Now, I think we've bottomed in these markets. You can see the positive divergence on the momentum indicators at the double bottom with the touch there and the touch there, momentum indicators trending up. So I think that indicates the bottom's in. We've got some resistance here around this level, but you can see again this week tried to break through that and had a little bit of a sell-off. If we go to the 1-year chart and let's just clean up that a little bit, you can see, no surprise, that's the high from December 2023. And look at that, the bond market touched exactly the same level, or this particular ETF did touch that level. So no surprise to see a little bit of a pullback from that level. It did have a fast run up. You can see it was in a little bit of a uptrend channel, broke out the top of the channel, probably just coming back to test support there, or to test the breakout there. And I would expect it to move higher. If we come across to another key measure, which is TLT, this is a fund that owns 20 and 30-year US government debt. So there's far more volatility in the longer time frame debt. If you'd like a deeper explanation of that, please reach out. I'm happy to explain a little bit more of the mechanics of how the bond market works. But you can see from July 2020 to the low in October of 2023, the US long dated bonds, the 20 and 30-year bonds, fell in price by 51%, a historic collapse. We've never seen bond prices fall this much. And again, you can see now it did make a fresh low in 2023, so I was wrong about this particular area of the bond market bottoming in 2022. But again, we see the same things we've seen many times before. Positive divergence on the momentum indicators as the price is making a bottom. That's generally a buy signal. And depending on how you want to draw that, I would say it was in a downtrend there and looks like it's breaking out of the downtrend. Now it still has to get past this previous high, and you can see it touched that to finish the week last week. But I think we're in the process of forming a bottoming pattern. And if we zoom into the 1 year so we can get a little bit of a closer look, you can see again, December was the peak. Didn't quite get there when we zoom in, but you can see it was in a downtrend through the start of 2024. And then around June, July, I think it broke out. So we see this kind of price action all the time where you've got the resistance being tested there, or the ceiling. You see a breakout, return to the scene of the crime, a higher high, return to the scene of the crime, just sort of consolidating a bit there. Now it's broken out again, and I would say that was the resistance there, probably coming back for a test. And then I think the most probable outcome is that it continues higher from there. So, and I just want to point out, if you're watching this and you are not a client, please keep in mind this is not investment advice. Just looking at the markets, looking at the data, what's happening, and letting you know what I'm doing and what my clients are doing personally. That doesn't necessarily mean that it's appropriate for you. Let's have a look at the gold miners, GDX. Now, gold is so this is the high in August of 2020 when gold hit 2087, or roughly around the $2,000 level. Gold is about 15 to 20% higher in price today than it was at the peak there, yet the gold miners are down 21%. So they've very much underperformed. But if we have a look at this downtrend they've been in, you can see they're attempting to break the downtrend. So touch there, a breakout, a return to probably just test this level here, and then most likely heading higher. But I do remain cautious on the gold miners. They did have a good run from February this year until July. They went up about 53%. So they've had a good run. So I remain cautious. But longer term, this is positive to see that they're breaking out. You can see another little sort of falling channel pattern there. You know, little bit of consolidation. There's not too much else to have a look at on the chart. That's why around these levels, I'd be a little bit neutral, a little bit cautious. And another reason to be cautious is we've got no clear direction from the US dollar. This is a 5-year chart. You could argue that it's kind of trapped in this consolidation pattern here, and it's at the lower end of the range. So maybe it's going to pop out. And if we go to a 1-year chart, you can see the low from March. It's testing that low at the moment. Generally, a rising US dollar is bad for most of our investments or most asset classes. Again, in general, so there is that concern that the dollar is going to rally back up that way, move back towards the top of this channel and test it again, and that would probably put weakness or put downward pressure on things like gold miners, certainly on stocks. So something to be not concerned about, but just something to be aware of, be cautious. Aussie dollar, since the March 2021 high, the Aussie dollar has been in a significant downtrend. But so you can see the touch there, touch there, touch there, and have a look at this. It is starting to attempt a breakout. You saw it popped above there, but got to that previous high, and now it's fallen back below to test. So still very much in a downtrend, but notice the low from October 2022, a higher low in October 2023, and it's kind of bouncing along here now. So looks like it wants to do that. That maybe the downtrend is and the Aussie dollar is coming to an end. We'll see how that plays out. Generally, the Aussie dollar is considered by the rest of the world to be a quote commodity currency or a risk-on currency. So if you're seeing the Aussie dollar break out, that's probably a bullish sign for commodities, for gold, for stocks. So we'll keep an eye on that, but it does look like it's trying to or trying to end this downtrend and break out and begin a new uptrend, or at least end the downtrend. Let's come across to Aussie stocks. So we're looking at a 5-year chart. Now, I've shown this a lot of times in previous videos, so I don't want to spend too much time on it, but I'll just quickly show you the high from August 2021. And we're now seeing, so I remain cautious on the Aussie market in the short term, but this is a longer term 5-year chart. Very textbook. You can see, and I think it's an inverse head and shoulders pattern. We've got the shoulder there, a double bottom for the head, and when it double bottomed, you can see there was some positive divergence on the momentum indicators. So you could buy after a sell-off. And I told a lot of my clients in October 2022, don't be short the Aussie market anymore. It's underperformed. I think it's going to bounce from here. So we saw positive divergence, double bottom after a significant sell-off. And then you've got the shoulder here as well. You could almost argue a case that that's a little bit of a bullish consolidation pattern. And you can see the breakout, test the previous level, return to the scene of the crime, and now it's broken out above this neckline. So the inverse head and shoulders pattern is complete in my view. And now it's returned to, sorry, just had to pause for a moment there. So you see breakouts occurred, return to the scene of the crime, makes an all-time high. And what concerns me a little bit, so for starters, I don't think we should have an aggressive allocation to any asset class that's at an all-time record high. So the Aussie market did just hit an all-time record high. It's in this sort of broadening wedge type pattern, a little bit messy on the draw there, but you can see what's happening. It's generally a bearish pattern. And as the price is making a higher high, the momentum indicators making lower highs, that's generally a sell signal. So I expect it's probably going to bounce around here for a bit. So I've been advising my clients to have a smaller than usual allocation to Aussie stocks, and that we be more in, rather than being in growth funds, we're in income funds, covered call funds, just playing it a bit cautious. The market is still expensive long term. If we go to an all-time chart, you can see the Aussie market is still way up from where it was 10 years ago. But if we remove some of those lines, you can see on a monthly chart, again, very obvious sort of pattern there, that inverse head and shoulders. So you can see longer term, this is a pretty bullish sort of breakout for the Aussie market. And if you want to, I don't always like angled trend lines. I like previous key levels. Keep in mind, in August 2021, this was an all-time high for the market, so a very key level. So you can see that level there, lots of touches, breaking out. Now it's bouncing along there. So I would expect a bit of this, and then eventually, maybe next year or so, I would say it's most probable that we go on to make it new all-time highs, maybe even later this year, depending on how aggressive the RBA gets with interest rate cuts or talk of interest rate cuts. Let's have a look at the US market on a weekly, the S&P 500. Again, this thing is US stocks have had an amazing run. You can see some negative divergence there as the price makes a significantly higher high. The momentum indicators making lower highs. Uh, I would again, telling my clients to exercise caution. Don't be out of stocks, but don't be aggressively long stocks here. You can see these markets are just way, way up. We're actually having a look at a monthly chart there, but if we zoom in, let's have a look at a weekly. Again, you can see the same thing on the weekly. The price has been in a significant uptrend. You can see it broke below that uptrend, so it's probably going to return to the scene of the crime and maybe do a bit of this. That would be what I would think would be the most probable outcome. You can see again at the high, price making higher high, momentum indicators making so higher high on the price, lower highs on the momentum indicators, generally a sell signal. You may also, if you wanted to draw that, you could say, well, that's a very tight rising wedge pattern. Again, I'm not the biggest fan of angled trend lines, but there is a case to be made there that it was in a rising wedge pattern. If we zoom in and we look at it on the daily, a little bit harder to see what's going on there, or you could say there's a smaller uptrend channel. There's an example of what I talk about. Uptrend channel, holding the channel, breaks down from the channel. Let's zoom in a bit. You can see a breakdown from the channel, return to the scene of the crime to test, sell off. It's probably looking to do something like that in the short term. So again, I would exercise caution, and I'm telling my clients not to be completely out of stocks, but to be more in income funds than growth funds and have a sensible allocation to stocks. We have a generally similar or larger weighting to bonds. I think bonds are far more underpriced. Let's have a look at gold. Gold, despite the broader commodity sell-off, gold has held up exceptionally well. This is again a 5-year chart, so going back to the high from 2020. You can see that level around 2050, very key for gold. If we draw a line across there, we can see a lot of activity at that level. That was the all-time high in August 2020. Then March 2022, it tested that level again and sold off. Tested it again in April 2023. Then you can see in December of 2023 and January, February 2024, it started to pop its head above that line a little bit more, and there was a tight consolidation pattern, lots of consolidation. And then once the market resolved that, up it went, making a fresh high. And if we zoom in a little further, you can see that once it reached this sort of 2,450 level, we could draw a line across there and say there's a little bit of a consolidation pattern there, lots of bouncing and testing. And these are weekly candles. So you can see 2 weeks ago, broke out from there, closed above there, and we've got another candle close above that level. So and if we zoom into the daily, we can see it a little clearer. You could probably move that line up or maybe there's fine. You can see lots of touches there, sell off, support there at 2,300, resistance there at around 2,450, support at 2,300, eventually breaks out, makes a new all-time high, returns to consolidate, but note it didn't come all the way back down to the bottom of the channel. That's a good sign. Popped out the top again, testing the roof. This time it held, and I am cautious on gold in the short term, but this is pretty encouraging price action on the chart. So I'd say good chance that it continues on upwards. The only thing that sort of concerns me a bit is as the price, and let's just clean that screen a bit, as the price is making a higher high, the momentum indicators are starting to roll over. Not a strong signal there, but just indicating the uptrend might be a little bit exhausted for the time being. Let's keep in mind that gold bottomed in October last year around 1800, and it has gone up 36%. It's had a good run. Let's be cautious, have some allocation, but not a full allocation. Sort of similar deal with silver. We're on a weekly chart. You can see the $26 level is very key for silver. Um, you can see resistance there in April 2022, tested again in April 2023 and November 2023 as the ceiling. And as we see quite often with these key price levels, or I like to call them magnet levels, you can see the price, silver breaks out, makes a fresh high, returns to the scene of the crime, because if you imagine a resistance level as a ceiling, as a roof, once you smash through the roof, the old roof then becomes the floor because you're standing on the roof now. So returns to the scene of the crime, makes a new high at 32.40, and now it's selling off and it's testing that level again. So we'll probably consolidate here, and then I expect most probable outcome, silver to go back up, and I would be a buyer down here at these levels. Let's keep it moving because we're up to 15 minutes. Let's try and keep it to 20 minutes. Oil, in the shorter term, oil found support at the previous low in June. A little bit of no man's land here. Not too sure what to say about the price of oil at the moment, other than I don't know. I don't think there's any clear direction. You can see it was in that uptrend from the low in December, and sort of got this rising, broadening wedge, which is generally a bearish pattern. And then note again, once it broke below that support line, notice how it breaks below, spends a bit of time testing, and then once the market was satisfied that it had tested that breakdown, it made a fresh low back up to test that old channel, um, and then back down to test the support. So right now at no man's land, I'd be a little bit bearish here, and down here I'd say, I'd be a little bit more bullish. I'm not participating in any oil related investments generally at the moment, so not buying oil stocks. Are buying some broader, like diversified mining. Then for ETFs, there might be some oil mining in there, but no clear direction on oil at the moment. So we'll keep an eye on that for other videos. Now, I won't talk too much. I'll just keep this to a couple more minutes, but I've talked before about um, how much debt the US federal government is in, and this is from the Federal Reserve's own website. So this is not a conspiracy website or anything. This is actual data from the central bank, the Federal Reserve, and these are interest payments on debt. So the US federal government is now spending $1,089 billion to pay interest on their debt per year, keeping in mind that those are US dollars. So that's about 1,700 billion Australian dollars. To put that into perspective, the Australian federal government, the entire spending of the Australian federal government is about $680 billion. So the US federal government is spending per year almost 3 entire Australian federal governments just to pay interest on their debt. And we've looked at the bond market a little bit in previous videos, and I might do a dedicated video to the bond market itself once we get some more precise movements or clear movements. But one thing that I have talked about in previous videos is something called the yield curve inversion, which I know sounds a little bit like economic gobbledygook. Gobbledygook, however you say that, like mumbo jumbo was probably the term I was looking for there. In short, what it means is that the interest rates on short-term debt are higher than long-term debt. If we're looking at over here, the interest rates or the yield on US government bonds, you can see if you loan the US government money for 1, 2, or 3 months or 6 months, you get 5% or 5.3% interest. But if you loan the money for 10 years, you only get 3.94%. So that's the market telling you that there's a problem, that interest rate cuts are coming. Like even the 1-year bond is trading at 4.49% interest. And without getting into a detailed explanation, what it generally means is that a recession is coming. And if we have a look over at this chart again from the Federal Reserve, and this chart goes back to 1982. Let's just make sure I've got the maximum there. So this is the Fed's preferred measure where they measure the 3-month Treasury yield. So the interest rate on 3-month US government debt, which is currently 5.22%, and the difference between that and the interest rate on the 10-year. So let's have a look at each time there was, these gray areas indicate a recession. So in 1989, you could see that the interest rate on the 10-year government bond fell below the interest rate on the 3-month bond. And then, of course, that situation reverses and you get a recession. You can see again, just before the dot-com bubble burst in November 2000, you can see again the yield curve inversion where long-term interest rates fell below short-term interest rates, or effectively cash rates, like cash at bank rates. And again, a recession occurred. It happened again in 2007. We know what happened after that in 2008. There was a massive recession. Look at that, just before, in August 2019, just before COVID hit. Again, the yield curve, the bond market predicted some kind of crisis or recession. Now, have a look at how small that COVID recession was in length, like in time duration, relative to 2008. And that's because if you've been following me for a few years, at the time, central banks went to immediately. There was no mucking around. They just almost immediately slashed interest rates to zero, and they launched these massive money printing programs, trillions of dollars printed in very short periods of time, and they managed to prop things up. So have a look at 1989, 2000, 2008, just before COVID, recession, 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 recession. Have a look at where the yield curve inversion is now. This is the deepest and longest yield curve inversion